Goldman Sachs scrapping its plans for a direct-to-consumer credit card, the latest black eye for the banking giant. Top analyst Mike Mayo slamming the bank this morning on Squawk Box.
Why were they allowed to lose billions of dollars in expanding the consumer business without someone stepping in and saying enough? And this transcends the current CEO. David Solomon, the current CEO, leaned in, but at least he's cutting the losses now. So I want to know what broke down in the financial controls that allowed them to spend so much for so long.
And then there's this. This is a headline from the New York Times earlier this month suggesting CEO David Solomon's side hustle as a DJ may be a conflict of interest. You don't see these kinds of articles when a stock is doing well, when a company is doing well. So is there a crisis of confidence at the company and a crisis of confidence about its CEO? Jeff, what do you say?
Yeah, there could be. I mean, we'll see what happens relative to leadership there. But to your point, when the stock's not doing great, it's easy to start pointing fingers. You know, I just think, and we talked about this right after Goldman's earnings call, you know, they bit off a little bit more than they can chew, and this year is likely one of retrenchment. You're probably going to have balance sheet reduction, expense cutting, and scaling back some offerings, and I think that's what we're seeing in terms of the consumer business. So I think the stock is probably, at the very least, range bound for quite a while. And that push into consumer was really a push toward looking for more durable sources of revenue. So they don't have it there. You know, it could potentially be in asset management. But if you look at the difference between, say, Goldman Sachs and Morgan Stanley, the difference is stark. Looking in the asset management business, Morgan Stanley, you know, $1.4 billion of earnings, 18% ROE. Goldman Sachs had a slight loss, negative ROE. So, you know, there's an issue there that they need to fix relative to sort of the durability of their revenue profile if that's where they want to go with this business. Yeah,
and for Morgan Stanley, it was a multi-year transformation that involved a few different acquisitions along the way, Guy.
Big ones.
Yeah.
Yeah, and they did that seamlessly, by the way, and they did it at the right time, too. They got themselves in the asset management and the RA, you know, the financial advisory business a lot sooner than people probably thought, and at the right time, as it turns out. But in terms of Goldman Sachs, and since you mentioned, you know, where are we in terms of David Solomon, this is a company since 1969, the gentleman there that was there for 40 years prior. Since then, they've had 9 CEOs. So the average tenure is about 5.5 years. Lloyd was sort of at the higher end. I think he sat there 12. So with that said, you know, this year, next year, David's probably getting long in the tooth. And is there going to be a switcheroo in that seat? Probably yes, but that does not signify anything. It just signifies what Goldman's done. The last quarter was not good. They've admitted they've made some mistakes, but I think you stay long Goldman Sachs here.
Let me ask a question. If the headline crossed, David Solomon is, I don't know why. I can talk whatever.
Okay, sorry. Okay. You keep doing it. You do it well.
David, if the headline crossed that David Solomon was stepping down, leaving his post, would the stock go up?
I think he's an easy target right now. To answer your question, yes. However, I think people need to relax, and they've got an investor day in a couple of days. They're going to reiterate a target of 15 to 17% on return of tangible equity. Their fourth quarter wasn't great. If you look at this, and again, relative to the money center banks, it's apples and oranges. But if you look at a 5-year chart on Goldman versus all the other big money center banks, you're doing fine. And Goldman, this hasn't necessarily been an environment where Goldman makes their money. They will be back. I would be buying weakness.
And remember what Mike Mayo also said. This is the most recession-proof banks financials have been. So this is clouding it, making this focus on Goldman Sachs. The best chart in the space is Morgan Stanley. So I wish I had a must trade versus a just trade, but right now, I'm still long JP Morgan.